I'd like to come back, take you back into the past, right? Which I don't come across a lot of people that, worked as you. I don't know, probably I can count. Maybe if I go through my LinkedIn connections, I'm gonna find maybe one or two pilots, people who are either right now flying planes or flew planes before. But you did that. So I think it's kind of
Yeah,
awesome.
that was
Yeah.
where I came out of school thinking that was the career, aviation, go to work for Delta because I'm from Georgia and
Yeah.
I'm born and raised in Georgia, and Delta's Atlanta, right? Southern Company. So that was always the career path, or at least so I thought. It's like, yep, that's what I'm going to do in life. And I just realized I'm not a good employee. So that's what I figured out is I don't do so well in a job. No, I did work as a pilot for some years. I had a corporate position flying in a corporate job, but it was great. And flying airplanes is wonderful. Being told when to do it, where to do it, how long to do it, that part's not so fun. So that's where I kind of departed from all that. But it was fun
And
flying the airplane part.
so when you mean corporative, so private?
Private corporate. Yeah, it was a corporation, but owned by some doctors in the city that I lived
So
in. And
what you flew? So what was the plane that you used to fly?
yeah, I flew mostly a Lance Air. It was at the time it was a newer, it was a brand new airplane at that time. I literally went up to the factory up in Oregon and flew it out of the hangar as it was built. Smelled like a brand new car on the inside. But that was a small composite single engine four seater. That's what I flew the most of. And then I was just starting to get into some jet time, into a Westwind jet, a little right seat in that, when I wound up going full time in real estate, kind of walked away from that career. So yeah, it's
Yeah.
just gonna go to the next level when
Do
I
you,
when I
do you, do you still do that? Do
left.
you still fly?
I don't. I haven't flown in quite a while now. People ask that occasionally, and I always kind of if you give the example of like saying, well, if you had a bus driver or a cab driver, would you invite them to go drive your Toyota? It's
Yeah.
like
Yeah.
I flew airplanes for a living, so I don't care about just flying something.
Yeah.
Now, if you've got something fun to fly, if you want to go do barrel rolls in a G5 or something, hey, I'm your guy. But if it's just let's go tootle around in some airplane to fly around for the heck of it, nah,
Yeah,
I
because
did it
I
for a
mean,
living.
there are some people, and I don't know, guys, if you've seen, John Travolta plays before, but that's pretty incredible. I mean, the house that he has, and
Right.
obviously he's a pilot and is one of the people, but he has like 747 and 707 and Hawkers and whatnot. So, it's awesome. I mean, have you seen his house? It's pretty
Yeah,
incredible.
yeah, and he parks the thing right in front of his house. Yeah,
Yeah.
that's another level. I would probably fly my 747 if I could park it in front of my house, but
That's the
someday.
life. Look, that's the life. You just jump in. Having a car, people think that's a luxury. Imagine having a plane parked next to the house. You just jump in and fly whatever you want. So that's the life, and I guess that's part of real estate. Is part of that is really building that freedom, so you can jump and go and do whatever you want. Over time, obviously, right? So, which the start of it is obviously is education, right? And that's partially why I do these podcasts as well, for people to really get the inside, the nuggets, collect the pieces, that people like yourself can share, when it comes to that education and getting started. And obviously multifamily is what you specialize in. So can you talk about the beginning? And you do a lot of education, by the way, right? So you guys can find, so what was the website that I was checking before? So it's Real Estate Raw, right? That you do a
Real
lot
Estate
of.
Raw is the company. Yeah, realestateraw.com. Yeah, that's the main site for my education program. I have been a multifamily owner operator for about 20 years.
Yeah.
So I started off in 2005 with a duplex, my very first deal. I my first 402 units of the little over 1,000 that I've had in my career. The first 402 units were done with creative financing only. So that was things like lease options, seller financing, stuff like that. And then I went on and got into syndication, raising money, doing larger stuff. So yeah, I've been doing it about 20 years, built a management company. I do teach. I have two books. The books behind me are both books that I've written that are available on Amazon. So yeah, I've been out about doing it for a while. The teaching is something I do on the side. That's fun. I enjoy it. The main business is real estate
Yeah.
itself, but I've
Yeah.
been doing
Yeah.
it
Yeah.
for a long time. Yeah, through several market cycles, including the crazy one we're in right now.
Oh yeah. So, but again, for the people, as going back to your story, so you started with the duplex, and then you obviously. So, when do you think the cap is that okay? You reached 400 what plus units, and you said, okay, now like I need to start raising. I need, and that's the smartest move, right? And again, if you guys are afraid of going and taking somebody else's money, you're already doing that. You're going to the bank, you're taking a loan. I mean, it's already happening. So but when and how have you decided decision, and why specifically multifamily? Because there's so many asset classes available. So why multifamily in particular?
Yeah, good question. Luck is probably the most simple answer. I was in houses, I was flipping houses, so I did technically start with multifamily, being a duplex, but personally, I really kind of put duplex in the category of like single family, small real estate, 2, 4 units. That's all about like a house. And so
Mhm.
I was flipping houses. I started very small, so I did not start with any sort of big head start or a lot of money or access to anything particular. I did not. The duplex I got seller financing on. When I quit my job, I had saved up $10,000. I had the duplex creating about $300 a month, and that's what I went in full time with. So that was it. And pretty humble beginnings.
Wow.
Flipped houses for a little while. Was doing that. I had started to save up houses. A few of them I'd kept as rentals. So it's kind of building the single family portfolio of rental property. And some friends of mine and I went to a seminar, and I was listening to the main speaker, and I noticed that off in a side corner there was someone speaking about multifamily. And so I thought, that sounds interesting. Let's go listen to the guy talk about multifamily. So I just happened to walk into that room that day when that individual was giving a lecture on multifamily, and I got the bug.
Hmm.
It was one of those things that just triggered, and I went, that's for me,
Who
and
was
been
who
here ever
was the guy?
since.
Do you remember who was this guy?
I do. It was a fellow named Dave Lindahl.
Oh yeah,
He
yeah,
from
yeah.
RE
Okay,
Mentor. Yep, he's
okay,
been in the business for quite a while,
yeah,
and that was my first teacher in the real estate business. Yeah, so I signed up with him originally.
yeah. Of course, that was a back question. Of course, you would remember
Seven,
somebody who made
15
an
years ago.
impact like that. Yeah.
Yeah, yeah, a long time now. That's been 50. I had to think about it, 15 years ago or so. Yeah.
Wow, wow. So awesome. So what would you advise now for the people? Because obviously you teach a lot of people, and obviously in between,
Absolutely.
probably some people is like, look, it's just too much, too many moving pieces. I want to do the passive and maybe invest with you, right? But for the people who really want to do actively themselves, what would you encourage? Again, is the path that you took, kind of starting with a few units, and then managing those properties, going maybe into bigger properties, 10, 15, 20 units, or starting as some people say, with
Yeah.
150 plus units indication.
I rarely see people start that large. A
Yeah.
few students have gone large out of the gate, that 100 plus. Very rare to see someone do that. Normally, your first deal is going to be that 2 to 10 unit range, maybe in that category. Maybe if you've got some partners, you might go 10 or 20 units. So I would say yes, the average student is going to get into that mid to smaller size asset normally within about 12 to 18 months of getting into the business if they are learning, getting proper education, and going out and actually looking at deals. So my students, on average, around 12 to 18 months for a deal, to get in. Now the second and the third come much quicker. So it's not like you're doing a deal every 12 to 18 months. It's just that first one. You're building your teams, you're building your credibility, you're having to learn to build a model. You got to learn underwriting, relationships. That's the big one. So back to your question, answer a little more directly. One, I would start with education, and I would start with the cheap stuff first. Everybody wants to reach out and sign up for some gigantic, multi-million dollar whatever program, and all the big name and the big speaker. I wouldn't do that. Just start with the book.
Yeah.
Start with a book that's cheap, watch YouTube videos, get all that kind of stuff that you can get. And then once you've consumed the cheap information, then go up to the next level of reaching out for maybe a mentor or someone that can actually help you,
Mhm.
move along. But just hauling off and writing a $20,000 check to a coaching program, that might work out for you. It might not, and that's a lot of money. So I recommend everybody kind of slow that down and just
Yeah.
get some cheap info first. That's my recommendation.
I think that's the key here. Slow things down is really because the thing, because some people might get really excited. Maybe they came across a video just like this one, and they're like, "Oh my God, maybe you are David Lindoff now," to the people who are seeing you for the first time. And I think that's happening. And people like
Yes.
multifamily, I never heard about this before. Let me check this out, right? And they're gonna start moving fast and getting more excited, which is great. but eventually you probably have to slow down and really start planning, strategizing, preparing. So when it comes to that, like what should go first? As I mentioned, books, right? So, and obviously there's a list, and you have your books, and there's all these moving pieces. So you mentioned team, you need relationships, you need to raise capital, you need to underwrite, you need to find deals. If there is a single individual that's listening right now, what's the most important? What's the next thing for them to do? Finding a team member, going in and trying to find a lender, starting underwriting deals. How do they pick a market? Like, where do they start? Because there's so many
Yeah,
different things out there.
absolutely. Pretty simple. All right. So I'll kind of answer this question as if you were my student and we're doing our first lesson, right? So
Perfect.
what I would tell you, there's several different areas that we kind of can come at this. It's kind of a circular topic, so we'll pick one. All right, what I teach students is that you need to think in the format of systems. So we got to start building you systems that will sort of run and operate and get a business going. The first three systems: deal flow, deal analysis, networking. And those are the three things, to answer your question, that you really, if you're brand new to this business, or even if you're not new to the business, those are the three things you must have all the time. You got to have deals coming in the door, and that's working with
So
realtors and
yeah,
such.
yeah, yeah, yeah. Sorry. So building relationships with
Right.
realtors. Yeah, yeah.
Right. So deal flow in all of the other categories and things that we can discuss fit under one of those three major topics. So if you say, well, how do I choose a market? Well, that's going to be under
Yeah.
deal flow. That's in that. How do I work with a realtor? How do I talk to owner? Deal flow, right? That's all into there. So we're getting the deals coming in the door, and there's lots of things to that, right? Okay, deal analysis. Now we've got them coming in. What are we looking at? What's a good deal? What should we offer? If we offer this, are we going to make money with this? Can we raise money for this at that price? All of that falls under deal analysis of what's a
Mhm.
good deal. And then lastly, can you pay for it? Networking, right? And this is where, and I take that from the adage, your net worth is your network, right? So that's where I have those three systems. One, you got to be bringing deals in the door on a regular basis. You have to know what you're looking at. And then you have to have the team and the investors behind you to
Mhm.
get those deals funded, unless you already have all the money you need to invest. If you do, call me. But everybody else, you need to get your team together. And then those are the three things you ought to be doing all the time. So if it doesn't fit under one of those three categories, then it's an ancillary task. Should we build a website? Yes, sure, but not prior to
Yeah.
one of those three things. Always be doing one of those three things. That's my answer to a beginning student.
That's awesome. That's a good advice. Regarding then, so if we start with the first one, deal flow.
Sure.
Let's say picking a market where you are, Florida, right?
Yeah.
Now for a person who's looking to get started, maybe to go through the doors and start talking with the brokers, they're going to be like, look, I don't know you. I don't know what you do. You don't have any credit. You don't have any history, track record to show, right?
Correct.
It could be a
Correct.
little bit difficult as they already have existing relationships with the local investors or national investors who are serious about investing, and they maybe been acquiring deals with them before. So that relationship can take longer time sometimes to develop. Maybe going to lunch breaks, taking them for a lunch or having whatever. So there could be creative strategies. I'm sure that you teach your students how
Of
they can
course.
build that relationship with the brokers. How about
Property tour.
say that again?
Property tours. That's the key. There's your secret tip right there. Everybody
Okay.
thinks it's about lunch and take them to dinner. No, that realtor can pay for their own lunch.
Yeah.
They don't need you to take them to lunch. They need you to close a deal.
Yes.
That's what that realtor needs, right?
Yeah.
So, step number one, you need to know underwriting. So, I'm actually going to say the underwriting comes prior to deal flow. Now, you need a
Yeah.
bike to learn how to ride a bike, right? So, we're going to get some practice deals. If you're working with me, I'm going to show you how to get practice deals coming in the door. We learn to underwrite. Once
You
you
need to
know the
you need to
map,
start speaking their language, right? So when they understand
there
you
you
become
go. And
professional, they
that's
immediately
it
close.
right there.
Yeah, yeah,
You got it. Because you're going to get one bite at that apple. And what I don't want is for you, my student, to reach out to a realtor. And the realtor is basically going to ask you one simple question. What are you looking for? And how you answer that question right there is either going to put you on their radar or not, and you absolutely nailed it. It's about credibility. It's about a relationship. And if that person picks up the phone and says, what are you looking for? And you go, oh, a really good deal. The cash flows a lot. Okay, come on. Who isn't looking for that, right? That's not a good answer. And that realtor won't take you seriously.
yeah.
If you understand underwriting, then you can say, well, I'm looking for, and you have a very good mathematical technical answer, that is usually a good enough credibility sort of handshake to get in the door to go do a property tour. And
Mhm.
that's where you want to start meeting real. That's the relationship builder. So you're showing up, you're doing property tours, you're underwriting deals, you're meeting that realtor, you rinse and repeat that model, occasionally making an offer. You know, and people say, well, hold on, if I go look at deals, aren't I wasting the realtor's time? No, it's a funnel. You know, the realtor has to send out emails to get property tours, to get offers, to get a sale. You're just fitting into the funnel, right?
Mhm.
But
Yeah,
that's the key. Yeah,
that's
that's
right.
the key. It's not, you know, I've written an article and it's kind of a joke article with it, but it's called Don't Date the Realtor, right? It's not a date. Don't turn a meeting with the realtor into a date. You're not trying to call these people up on a Monday morning and ask personal stuff and get to know them and build a relationship. They're busy, they're professionals, they're not interested, right? Show them that you're a closer. That's the key.
I love that. I love that. So, which I don't know the percentage what it would be. Obviously, I'm not, operating in the United States, but obviously there's going to be probably depending on the cycle that real estate is in. Majority of deals could be found if we're talking about good performing deals. Could be off market, right? And again, as I mentioned before, they might have preferred investors that come on first. So you might find what do you call it, just crumbs at the end of the day, the deals that
Right.
nobody wants, and they have those for you to be displayed. So maybe finding another creative way maybe to go in and for the new investors who are looking to start in multifamily, how about mom and pop properties? Do you teach your students, of course I would assume, to go and find the off markets, maybe get creative and knock on some doors and start talking with the
Absolutely.
owners that maybe want to exit the properties because they're sick and tired of operating those.
Absolutely. Yeah, you know what? I tell people there's only two ways of finding deals. You're either talking to a realtor or you're talking to an owner.
Yeah.
It's either or. So I teach both, right? And actually going to the owner is easier. Usually that's going to be in the form of obtaining a list somehow, you know, a mailing list, a phone list, some sort of list, and then reaching out to those owners. Now, how you close that, whether you're sending a letter or you're picking up the phone and calling them, depends on your script, you know, and I have different formats. So if you send a letter, that's one thing. But once you actually get on the phone with that seller, so we're not talking to realtors right now, just direct to owner. What I tell everyone is you need to be able to make an offer on that phone call within a minute of being
Mhm.
on that call the first time somebody calls you up. Now, when I say make an offer, I don't mean go to contract. I mean make an offer that will get you to the next level of conversation with that individual. Because if you send a postcard or a letter, this is we buy apartments, and you get a call from that seller, they're probably not, they're skeptical. They're probably not convinced this is a really legitimate thing. And so you need to bridge that and you know, shut down that insecurity quickly.
Yeah.
So in multifamily, and this is sort of a long-winded answer, but what I found is, you know, when you're trying to make an offer, you need financial information. You need the financials from that seller to say,
Correct.
okay, well, what is your income and your expenses? So let me make an offer.
Yeah.
If you send someone a postcard and says, you know, we buy apartments, and they pick up the phone and call you, and the first thing you say is, I need all your financial information,
Mm.
that tends not to go over real well. You know, they've called you, you're a stranger, and the first thing you're saying is, hey, give me all your financials. You know, I've found through a lot of experience that didn't work well. So I've had to develop a system for making an offer very quickly with very quick back of the napkin information. And that's what
So
I teach people how to do.
yeah, so sorry, Bill. So again,
Yeah, go ahead.
as I mentioned, which is an important piece, making an offer. So that's what I mentioned. The underwriting is it becomes such an important piece. So when you're making a call, you know what the number is, but for you to make that decision, you need at least some information, right? So again, you can be looking at the similar properties in the area, right, to kind of predict maybe. But what probably would like to see is P&L, right? So
What I'm
how
talking
do you
about. Yeah,
acquire that?
exactly.
Yeah. So how do you acquire that information from an off-market deal?
So if it's off market like that, yeah, like we're talking about right there. So what I do is, and I'll if you can put this in, I'll give you the quick formula. And so what I do is make an offer, and I'll back up and tell you how I do it. But I make a range offer. So if I do a quick calculation and my number is $1 million, I'm not going to say to the seller $1 million. I'm going to say, hey, it looks like I'm between 900 and maybe 1.1, 1.2 million, around this range. Does that sound interesting?
Mm,
And if they say, yes, we are in the right range here, then I will say, okay, for a very technical offer, I'm going to need financials, right? And so that's a back of the napkin offer that you can do real quick. I'll show you how to do that. But that's what I do, and so that's a better way of getting that financials from an off market deal than directly saying, hey, nice to meet you, give me all your financial info. That doesn't go over well. So here's what I do. I'll run through this quickly because people are, have the recording, and then we'll back up and discuss it. So you take number of units times the average rent times 12, divide by 2, cap rate, which I believe is multiplied by cap rate formula anyway. That
mhm.
gives you a value. All right,
Yep.
so what I'm doing here is let's say, I pick up the phone, you've called me and said, hey Bill, you sent me a postcard, you want to buy my property? And I say, yeah, I'm interested. And you say, how much? Always where we get to on that, right? How much do you want to buy my property for? Gosh, I don't know. I don't have my info in front of me. Can you answer a couple of quick questions? How many units do you have? 15. Okay, fine. What's the average rent over there? $1,000. I'm being general. Okay, so 15 times 1,000 times 12. There's your annual income, roughly.
Yeah.
Divide by 2. Okay, what I'm doing right here is taking a 50% expense
Mhm. Yep.
ratio. It's a rough estimate, and it is too much for small properties, but it's fast and it's conservative. So you take that, you divide by 2. That is giving you a net operating income. Again, an estimated NOI. Take that and multiply by cap rate, multiply by cap rate,
Mhm.
and then gives you the value. So the only thing you have to have walking into this conversation is the cap rate, either the cap rate for that market or the cap rate you want to pay. Like me personally, I don't think something built in the 1960s in America is worth more than an 8 cap, really, personal opinion. So I know I want to pay an 8 or better. I don't care what the market is. The market right now might be a 6. I
Mm.
don't agree with that cap rate. So I'm not going to use 6, I'm going to use 8. And that's all I'm going to do. Well, hey, tell me real quick, how many units do you have? 15. What's the average rent? Units times rent times 12, divide by 2, multiply by cap rate. Gosh, look, so all of a sudden I get $1 million. Well, gee, it looks like I would be paying somewhere about 9 to maybe 1.1. Does that sound interesting to you? And if they go, yeah, let's talk about, great. Now I'm going to need those financials. So that's roughly how I do that. And it's that sort of quick offer to let them know you're serious. And if the seller says, oh, no way, I would never sell for less than 2 million. And I know my number is more like 1 million.
Yep.
The probability of me closing that gap is very low. So at
Yep.
that point in time, I'm probably just going to retain the relationship. Hey, doesn't look like we're really a fit today. I sure appreciate you calling. Keep my number. If
Yep.
anything changes, give me a call in the future. The end.
Yeah. No, that's cool. I really appreciate that. That's going to
Absolutely.
be a
It
really
works.
valuable advice for everybody.
Yeah, it works.
Speaking about, so let's say if we move on down the pipeline to the process. So let's say now you're speaking, you agreed on a kind of ballpark price, the seller, the owner seems to be like he wants to be a seller and actually, sell you the property. So now you're going into LOI and later on into PSA, right? So let's say you're looking for earnest money right now, right? So if we say it's a 50 unit deal, right? And you're going to be doing a syndication. So how would you underwrite right now? So using an example, as we were talking about before, let's say you're in Florida and you found a 50 unit deal, right? Clearwater, for example. I don't know if if those deals are existing like that
So,
for
but
$2
yeah,
million. But how would you underwrite that? I mean, looking with the current conditions, if we're using an example of, cap rates, and now we kind of start looking at the entire picture, right? What's happening in the state, what's happening in the economy. So what numbers are you looking for to make sure that the deal eventually is going to work for you, for the investors that are going to be working with you in a deal?
absolutely. Yeah. So I'll answer that in sort of 2 different ways. Number one, how do we underwrite that deal? The exact same way you underwrite the deal at any point in time in the market cycle. It does not change. The math, the formula, the way we underwrite, all that is static. We apply that, the basics, really is what it is, the fundamentals. And you apply the fundamentals at all times. What you decide is a good deal, that changes, right? That so the what the equation produces, our opinion, is this good enough or not? Okay, that changes, but the math is always the same. So today, yeah, if you're out trying to raise capital and that's how you're going to do the deal, you need to be looking at this deal, asking sort of two questions. Is it going to produce enough cash on cash return, enough cash flow to satisfy the investors? Again, in this scenario, I'm assuming we're doing the syndication, right? So one, what are your investors going to invest for? 2% return, 5% return, 7. You would start there. Now that's just cash flow, something we're going to send them a check every quarter. And then you have internal rate of return, and that's a higher formula. But basically what we're saying there,
That's after you sell the property, right?
correct. And so what we're saying there is all of the profit that that deal produced, you calculate it back into an annual return. So that's where you have cash on cash. That's the return on investment produced only by cash flow, but it doesn't take into account the profit at sale and maybe depreciation and the time that you held the deal and all that stuff. That's IRR, right? And so that's an annualized return, if you will. So those are two main functions you're looking for, and you're looking for a deal that will reasonably produce those returns without over manipulating the data. And what I mean by that is any deal will look good if you go in there and tell it you're going to cut the expenses in half and double the rent and do all these amazing things. Yes, then the deal will show up and go, what an amazing deal if you're using like, you know, a calculator or something, right? And that's the problem that I've seen recently is people still using over projected rent growth to make a deal look good in a pro forma. You know, oh, we're going to raise the rents 10% for the next several years in a row, or the rents are below market, you know, and when you stop and look at the actual data in the market today, rent growth is almost completely flat in America. It's not up, not really. And you see someone come along and go, oh, we're going to raise rents 10%. And you look at the market data and the rent growth is 1%, and you think, okay, that's how you make a good deal appear good. But will it come to fruition? See, there's the catch, right? And that's one of the big things I teach in my class is LPs. I work with a lot of LPs. A lot of times people come to me not to learn how to buy real estate, but to learn how to be professional limited partners, how to underwrite a deal so that they're not writing a general partner a check that, you know, they don't understand that deal. So work with a lot of limited partners in that regard on how to be safe, you know, investing.
Yeah. And part of that is obviously now if you got the deal under contract and you know you're going to be looking to raise, you're going to be talking with investors, and obviously we can talk about that, and you know we can talk about the deal obviously a little bit more, and there's so much more to talk about, the exit strategy, the management of the deal, which a lot of people don't talk about. It's not a sexy, you know, a conversation because it's more of a, you know, what the IRR or cash on cash, or what, how much cash flow is the property producing, or how many units are we looking at? You know, those are, you know, those are great points, interesting to talk about. But the management, the business operation is sometimes what, you know, makes the deal or breaks the deal. You know, because there could be a lot of expenses. There's an entire different story with the management, and finding a proper management company to make sure that you're not overcharged on things that could be, you know, needed to be fixed if there's a, you know, an emergency, you know, sink is leaking, and many other different things that when it comes to just general management of the property, that could be a huge expense depending on the property,
Street.
what type of class you property you buy. But now if you got the deal on the contract, assuming, you know, okay, it's there, now you're going to go and talk to the investors. So now we have the PPM, private placement memorandum, and you want to talk to those people. So how would the conversation look like for those people who are looking to get started? Like, how do you tell the story, not sell, but actually tell the story for them to, to make sure that they invest with it?
Yeah, I would put in front of the PPM an offering memorandum, OM, an offering memorandum. So the private placement memorandum is the technical document that they review, the lawyer reviews, they sign, all that. But it's too much information for really presenting a deal. So what I would tell everyone to do is to create a presentation, a PowerPoint, or some form of pictures and charts and graphs type of presentation that's simple, basic, to the point, you know, and that's how you want to go out and start reaching out to people. Because let me give you the format here. When you're talking to an investors, they only care about a couple of things. Who are you? What are you going to do with their money? How much are they going to make? When do they get it back? That's about it, right? I mean, you know, if you just kind of create a PowerPoint or something that will say that, okay, here's who we are, why you're talking to us. Here's what we plan on doing. We're going to buy some apartments. We're going to fix them up, whatever. Here's what we do with your money. Here's how you get your money back. We're going to sell, we're going to refinance, whatever the case. And here's how much you're going to make. Stop. Don't, that's it. Just keep it to that, make a presentation out of that. And that's what you want to start sharing with people. Now, if they want to go deeper than that, then be ready for questions, be ready for more information. Big mistake I see is people thinking that just an avalanche of data is how you sell someone. And that is not true. You're just going to confuse people. So very simple, very to the point. Some people like to read, numbers and charts, and some people like pictures. So you kind of throw a little bit of both of that in there, and just make a nice several page presentation. That's it. Now, that's all I would do, and ask people if they're interested. Now, you start off with friends and family. So obviously you're not, standing out on the street corner handing out flyers to people walking by. It's not like that. You're walking, you're reaching out to friends, family, people that obviously know what you're up to, that they know you're in this business. So it should be a pretty soft start there. But yeah, that's it. Have that presentation, ask them if they want some more information, and give them a
And
pitch.
how would you say in terms of the structure of the deal? Because obviously, and I see, people are raising, kind of using different strategies. See, so maybe you can talk about that a little bit more. So 506B versus 506C, because one is accredited, one is not accredited. And again, it comes with the different issues, right? Because you're talking with the high net worth individuals versus, pretty much people in the street, as you're saying, that just walking on the street, and maybe they don't have net worth, but they could be investing with you. So can you talk about pros and cons, and what do you suggest for a newbie investor?
Well, first off, I would say I'm not an attorney. I'm certainly not your attorney, so nothing I'm saying is legal advice. We'll go with that one. But yeah,
Sure.
no. So yeah, the different regulations there. One we call the friends and family regulation, right? And that's where you can have up to 35 non-accredited 34, 35, don't quote me, non-accredited investors in your deal, and then everyone else can be accredited. Accredited, again, it's $1 million net worth, I believe, 300,000 in revenue. You can look that up, whatever the accreditation for net worth is, accredited investor. So that you can have more people in the deal that way with that one. But the downside of that particular scenario is you can only pitch that to friends and family. The law says at the moment that you have to have a prior existing relationship. So when my students are working in that regard, what I tell everybody is you need to go out and be constantly networking, constantly building that database where you have vetted these people, you can legally show a relationship, and they're in your database. You can now show any deal you want to that group. And I have a system, we move them through the system, and it shows that you've got a relationship, blah blah. So once they're in there, now that's your goal. That now all you have to do is go out and find deals, and any deal you find, you can reach out to this database and say who's interested. If you're going the other route, now you can go out and advertise. Right, this is, I forget, see whichever the later one. So you can go out and advertise now. You don't need friends and family, but they can only be accredited investors beyond that, right? So that means now, yes, you're open to advertising. You go on Facebook and say, who wants to invest in my deal? But you could not take friends and family in there, or again, you would be violating the law there. I will give the listeners, I don't want to call this a tip. I'm going to be careful with my words here. I'm going to repeat something that I heard an attorney say one time, because what that attorney said was really smart, and I think it's worth repeating, but I am not telling you to do this. An attorney once told me that you can start under the friends and family filing, allow in non-accredited investors, convert the filing, and now you're in the Reg C or whatever. So now you're bringing in, and now you can advertise with accredited only. So the non-accredited filing is a window you leave open for a while and then
Yeah.
close. And then once you close it and you convert, you cannot convert back. So once you convert forward larger, and so an attorney once told me that was a possibility. So you
Make
may,
sure
if you're
to
looking to
check
do,
that with your attorney,
but that's
depending
what
on the state
so
that you're.
definitely go run that one by your attorney. But an idea. So if you've never considered this concept, this is why I'm.
That's awesome. That's awesome. That's interesting. And again, so those are very interesting strategies. So again,
Right.
if it's accredited, but a lot of people tend to choose 506B or
Right.
C. It really depends on the deal, depends on an investor. But how would you? Because again, for the non-accredited, is you know, there's not much vetting that you need to do, I guess, right? How does it work with the accredited investors? Should an investor, because if I approach an individual and they say, okay, I'm accredited, you know, like I feel that,
Right.
like, should you trust an individual? Should you
No.
vet it yourself, or should you outsource and pay for the company to do that?
Well, okay. See, that's again, that's almost a legal answer there. And so what I can tell you is the law says right now that you have the responsibility to, or you're taking responsibility for their accreditation,
Mm,
right? So in the past, and I can kind of clarify it this way, in the past, yes, their word was good enough.
right.
If this individual showed up to you and looked you in the eye and said, I'm an accredited investor, that was good enough. You were not legally, responsible for that. Well, they've changed that. So now their word is not good enough. You imagine yourself in a court of law have to prove that you or someone on your team did some diligence to vet it. So now we answer your question. Okay, well, it has to be done. Can you personally do it? Sure, you could. Could you hire a CPA or someone? Sure, you could. What you really need, in my, again, non-legal opinion, is you would want something from their accountant or from their financial advisor or something to that level from some certified individual where they, with their signature, certify that individual. I'm such and such law firm and I do such and such guy's taxes and I certify that individual to be credit investor,
Maybe
accept
like
that.
a questionnaire on the website could help also, right? If you ask
It
certain,
could, but see, I don't, again, that's their word for it.
yeah.
You want to go further than that because you hand them a questionnaire that says, do you pinky swear you're accredited? And they go, I pinky swear. That's not good. According to the law, and my understanding of the law, that actually is not good enough anymore. You need to
Yeah.
have something in there that says, no, they showed me something. So that's where, to answer your question, you could do any of the things you suggested. Sure,
Right.
you could have your account do it, their account do it, your attorney, their attorney, but it better be done.
Yeah.
Because if something goes wrong, that's where you would want this assurance for yourself to say, well, no, Your Honor, I did these things. This individual lied so well, their accountant even lied. You'll be fine there. But
Yeah.
you go, no, he just swore he was accredited and they're not. Well, that's not good enough anymore.
Yeah. Got it. So you see, like, you need to have all these checks and balances in place to make sure that, because again, you're operating as a fiduciary, as an investment company, so you know it gets serious here. So,
Absolutely, it does.
but that's what the attorneys are here for, and that's what the
Just
mentorships are here
exactly.
for. That's what the podcasts are here for. There's a books for. But now again, only the portion of it. So when we're speaking about the equity, will be coming from those passive investors of yours, right? So the other portion will be coming from, you know, some other form of equity. So it could be a hard money lender. It could be, you know, one investor. I don't know. It could be an institutional capital, which a lot of people might not qualify because they don't have the track record yet because they're just getting started. You talked about creative financing before, right? So what would you say right now with the current terms, you know, and hopefully this is going to be obviously relevant in the future at some point for people who are going to be watching this. So how would you advise to structure the first deal? Looking at the same example, Florida right now.
So step number one, and this is again a pretty simple, pretty straightforward answer. So what I tell people is when you're first looking and you're trying to figure out, the first deal or size and all these, it all kind of flows together. How are we going to pay for the deal? So step one, are you trying to go to a normal bank, a normal lender, something like that? Right? If the answer is yes, we're trying to get 75% from the bank and we're going to put down 25%, wherever the 25% comes from, investors, lenders, whatever, doesn't
So,
matter.
so Bill, if you don't mind me, so what will be the correct like LTV that, you know, loan to value that people should be looking for? Those are also some numbers there.
Okay, again, details that we definitely get into in the program. Again, a simple answer that may not really answer things so simply.
Yeah,
1.25 debt service ratio is
yeah,
the answer to your question. How
yeah,
much loan to value can we get 1.25 debt service ratios worth on the NOI is my very technical answer. Now, if you
mhm,
understand what I just said, that makes perfect sense. If you don't, you're going to go, what? Okay, so what I'm saying is the bank has a requirement for the property to produce a certain level of income
mhm,
versus its loan. And that's what we call a debt service coverage ratio. It's the net operating income to the debt. and a lender wants to see you with about $1.25 in operational money for every $1 of loan payment. And so this is one of the analysis that we do when we first come in. And this is why I was saying, if you're looking to get started, it's step one, how are you going to pay for the property? All right, is it a bank loan? Because if it's not a bank loan, if it's all cash, that's different, you know.
Yeah. Do you mind, Bill? So sorry again for interrupting, but I think it could be again valuable for people just to, as an idea. So if right now, if you look at the interest rates, so the history of interest rates, right? Because if increased interest rates and we saw the increase, that means more of the insurance cost, more in terms of operating expenses on a property, more administration, marketing costs everything goes up, right? Even if you want to, boiler breaks down, and now again, you're having, a company come in, and again, management might be charging more. So those, inflation plus the interest rates, create, adds more of it. So do you think it still becomes 125? When we look at the, the DCR, or that should become a little bit more?
No, it's going to be around 125. Most lenders, you might see it around 1.3 if they don't like you, but most lenders are around 1.25, pretty standard. Okay, but what you just mentioned is absolutely accurate. The rates go up. What does that? And let's just quick math. Let's say we have $1 million property and we leave the price at $1 million. Everything else is standard, and the rate goes up. What does that do to that debt ratio, the debt service coverage ratio? It goes down. There's only two ways you could solve that problem. And this is where I was getting to. When you go and sit down and look at a loan and you say, gosh, if I put in the price and 25% down payment, let's just pick a number, and the debt ratio is 0.8. Okay, the bank is not going to give you that loan because you're already in foreclosure. The bank says, no, you got to be at 1.25. There's only two ways you solve that problem: pay less or borrow less. And this is where I was going to. So if we keep $1 million property and everything's fine, everything's normal, and the rate goes up, nothing else changes, that makes the debt ratio go down. There's only two things you can do when you come to buy that property: is lower the price or put down more down payment. You lower that loan to value. So we started with 75, try 70. Try 65, 60, 50. At some amount of down payment, you get that debt ratio to go back up. And that is what lenders are doing right now. So everybody's saying, oh, see, the lenders are lending less money. No, they're not. They're still lending 1.25. They've always lent 1.2. You're paying too much. You're paying more than they're saying, hey, if you want 80% loan to value, no problem. Pay less. And if you want to pay all this for a cap and all this price up here, that's fine. We're just not following you in that valuation with our loan. We're still down here at 1.2. So all of a sudden the down payment becomes 60% or 65%. And people say, gosh, the bank's not lending. But no. It's an illusion. They're lending the same amount. It's the price that has gone to a place they don't like. And that's the problem we have today. So what are we about to see? Well, either you're not going to cash flow anymore, or the prices are about to come way on down. Yeah. I'm going with the latter.
Yeah. So, and there's so much to cover here as well, because as we've seen in 2008, there a lot of people were over leveraged, right, and a lot of people went under because of it. So,
and as you mentioned, expenses, insurance, and all that stuff, same as the debt ratio, same as the interest rate. All of those things suppress that debt ratio, which suppress the value.
Yeah, because and that's why it's again important, underwriting, debt structure, and a lot of it is, again, as you mentioned, when we booked the call, you want to talk about scaling multifamily portfolio, right? So again, if, let's say, as we kind of run through, you guys really understand, at least give you a glimpse. Obviously, Bill can really teach you the ropes and how to go through the entire process, as he done with tens of thousands of students, obviously, and you can find the links included there for you to continue to learn from Bill. Now we're looking to scale the portfolio, the 50 units that we got from this mom and pop. So how do we do that? I mean, now probably we're talking about team expansion, acquisitions, underwriting. Like, how do you build a team, conferences, networking? Now you're looking to scale. How does the scaling process look like, and where, again, people start while they have that first property?
It's a function of your net worth. Is net worth thing again, right? So what I tell people, this is kind of another way that we circle back around to market selection. I know we're not talking about market selection, but we actually are. So what I tell people is you need to get several deals coming in the door a week. All right. Well, then our market is somewhere that we can get several deals coming in the door a week. What kind of deals? What's the right size for you to get started with? A duplex, 10 units, 100 units? Those are not the right questions. The right question is, how are you going to pay for this? Well, I'm going to get a loan. Okay. Then let's talk about what it takes to qualify for a loan. Net worth equal the loan amount. A lot of people don't know that about debt service ratio loans, and that's what we're talking about. These are commercial loans over here, not like when you go buy a house or buy a car. It's different. So over here, they're saying debt ratio, hey, the property needs to make the mortgage payment. So that's we're checking on that. By the way, you, the borrower, need to be worth suing. They don't actually put it in those words, but that's exactly what the bank's thinking, right? And so the bank is saying, okay, if you want to borrow $1 million, you need to have net worth of 1 million or more dollars. So let's stop right there. All right, how do we get started? Where's this market selection, and how do we go to the next? Take your net worth, translate that into your market. How many units can you buy? There's where you get started. All right, so let's say right now your net worth is 1 million bucks, and you say, I'm going to look in Atlanta, Georgia. Fine. How many units can you buy for $1 million in Atlanta, Georgia? There is where you get started. And I'm not saying that you stick there. I'm just saying that's your over under. So back to your to answer your question directly, when you want to go to the next level in your portfolio, how do you do it? You increase your borrowing capability. So therefore, probably increasing your partnerships, probably increasing the team that you're going to have around you. So the first team that I would be worried about increasing or going to the next level with would be equity partners. The people that come on with the balance sheet, either the experience or the net worth to allow you to borrow more, because if you can borrow more, you can buy more. If you can buy more, then you're going into the bigger properties. But you could go out and look at 100 units, 200 units, and have zero net worth. And it's not a zero probability of closing that deal. It's just real close. You know what I mean? So that's all I'm doing with this is trying to say, let's do the old 80-20 rule, right? 80% of the time, you want to be looking at deals with the highest probability of closing. Hey, 20% of the time, let's go chase that big giant deal, right? What is your personal 80%? Your net worth of either your net worth or whomever you can immediately get to co-sign a mortgage, friends, family. We talked about it. It's that group, that net worth translated into units in your market, Atlanta, wherever, right? England, Ireland, whatever. That's how you get started. And that's where you decide where your starting point is and how you can go to the next level. It's borrowing capability.
That's amazing. That's awesome. Yeah. So again, that's how you scale it. I mean, in a nutshell, right? That's how you start. That's how you scale. That's how you grow. But to maintain that, to get started, to get involved into anything, there's a lot of it is this internal communication that we as humans have, right? And all these roadblocks, and we talked about scams right before we started recording, and educational systems obviously depending who you talk to, and I deal a lot with academics, obviously they're swearing at me right now while they're listening to this. It's, there's all these false sometimes ideas that we got in our mind that we have to break. I cannot do this. This is too expensive. Who am I to go and talk with the people, who done so much more than me and ask them for money to invest in this deal, whatever that is. So Bill, what would you say that helped you, or you see other investors also when it comes to just this becoming more as a human, right? And well-rounded, like what's routines do you personally implement yourself in your life that works for you, or you seen other people doing just to becoming more as humans, as investors?
Yeah, that's a lot of answers there. I guess it's probably the old, who you surround yourself with kind of scenario. So, yeah, I would really listen to, podcasts, things like this as much as you can. Mindset is huge.
Yeah.
Really, what you fill your mind with, what you fill your day with. Yeah, spend something I would tell everybody, spend all the little downtimes of your day listening to podcasts and things. And if you're in line somewhere, you're in the car, you sort of wasted minutes out of the day can all be filled in with just listening to something in your ear, or education, all these things. So I'd say that's one of the big things is really focus on your education, surround yourself with the right people, and practice. Practice. That's the other thing that I guess I'll give you that one as the last one. There is practice. You have to understand that the success takes practice. It's not something you're likely to get right early on. As a matter of fact, you're probably likely to get it wrong a whole lot. And that's good. So be prepared for practice. And if you're prepared to practice, then I think you've got the right mindset.
Yeah.
If you're one of these people that thinks I've got to get it all right, 100%, no mistakes, can't fail, got to be perfect, you've already failed.
Yeah, so true, so true. So I mean, it is a complex game, and right now, but it seems like I've been looking at some stuff as well, and right now, especially speaking of in US, and obviously Europe is seeing a different situation, but obviously you can find these pockets where the good deals exist all the time, regardless of the market conditions. Me just talking with the people, I do realize that's what it is, but getting ready for those opportunities, right, is really prepping yourself, and you need to be in the zone to really have your eyes wide open, and look for opportunities, and look for the chances to make your next move, right? But everything, I guess, in this particular industry have to be just like in any business, calculated, strategically prepared. So, but a lot of it, again, as Bill describing, comes down to education, being, immersed. I guess that's the word. You need to immerse yourself, just like in anything else. Now we see the Olympics happening, right? And those people don't go there just, because they're, went swimming or, ran a few miles and that's it. It's immersing yourself. That's what makes you great. Like over time, right? Pressure builds those people, right? And it's same in business, right? I've been involved in different businesses through my experience, through my existence before, and it is what it is, and I speak with a lot of people like yourself, and this is the recurring theme. But again, for you guys and girls who are looking to continue to learn about this and looking to spot opportunities, get your hands onto the multifamily properties, get involved in real estate raw. You want to check that out. You want to connect with Bill, also on LinkedIn, Bill Ham. That's how you're going to find them. You're going to find those links included as well. And man, it was fun chatting with you. You just gave us the entire rundown. What it takes.
Yeah, man. Thanks for having me on. Good show.
What it takes to get involved. And I mean, for people, I guess they got a good glimpse. It's not easy, but I would assume it's worth it, right? So.
Absolutely. And it can be done, and it can be done by absolutely normal people. It's just not a get rich scheme. That's all. You got to understand it's not what these gurus are telling you, and you're going to come out here and get rich tomorrow. It's not. But it is absolutely possible, and you can do it. It just takes work, and it takes a little know-how. That's it.
That's awesome. All right. Thanks, Bill. Again, thanks for your time. I appreciate you for coming on.
Absolutely.
Thank you.
Take care. Talk to you soon.